Welcome to the GSX podcast, where we explore the evolving landscape of commodities, trading, and alternative capital. Hosted by me, Henry Walsh, and a team at Great Southern Cross Commodities, the podcast brings together market participants, managers, and investors to discuss how capital, policy, and innovation are reshaping the global commodity markets. From carbon to coffee, energy to macro, we cover the full commodity investment universe, unpacking the trends, risks, and opportunities that matter. Please note, the views and opinions expressed on the GSX podcast are those of the hosts and guests and do not necessarily reflect the views of Great Southern Cross Commodities or its affiliates. This podcast is for informational purposes only and should not be considered as financial, investment, or trading advice. Listeners should conduct their own research or consult a professional advisor before making any financial decisions. All right, welcome to the GSX podcast. Today we have a very special guest, a longtime friend and former colleague, Dave Behrends from Sucafina, a coffee trading company based out of Switzerland. Dave and I got to know each other a long time ago when we were early in our career at Noble. I was on the cotton business and Dave was in the coffee business. And from there, we have gone on different paths, but always kept in touch. And I thought Dave would be a great guest to have on the podcast, given his vast array of experience over the years through good times and bad and quiet markets and volatile markets. So welcome, Dave.
Thank you so much. It's great to see you and great to be here. Thanks for the invitation.
No problem. I guess just to frame it for people that aren't familiar with you or Sucafina, can you sort of explain what you're up to today, what your role is today? You know, Sucafina's business is broadened a lot, and which we can dig into, but just to sort of set the framing for people on the call,
Perfect.
to listeners.
So I've worked in, as you mentioned at the beginning, in the coffee industry now over 20 years. I think this might be my 25th year. It's getting to be so many, it's hard to count anymore. I originally started out on the larger corporate side of things. I worked at Louis Dreyfus first in coffee and then moved over to Noble, where we obviously worked together. And then in 2015, I had the opportunity to join Sucafina. And the big shift there was going from large multi-commodity, energy trading, metals, ags, large conglomerates to a pure coffee-only focused trader, family-owned, smaller company, but with a sizable coffee business. With the family, I was able to become a partner, so be able to take equity ownership in Sucafina when I joined. That's been over the last 10 years slowly growing. And we've also been able to open up the equity since then to other employees in Sucafina. So we have management as employees as a percentage of the company, which has been great. Sucafina was, when I joined, probably trading. I apologize, we talk in bags. It's not maybe the most normal metric. Some people talk in bales, some people talk in metric tons. Metric tons probably is the one that would make the most sense, but we talk in bags. So Sucafina, when I joined, was trading approximately about 4 million bags of coffee out of a global total of about, call it 160. To give an idea of size, last year, we probably traded about 11 million bags. So we've had a significant amount of increase, market share as well. So today we're somewhere about 1 out of every 16, 17 cups of coffee come through a Sucafina supply chain somewhere in the world.
Oh, it's impressive growth. I didn't realize it had grown. It had grown a lot, but I didn't realize it had grown that much. I guess in terms of growth, because it hasn't just been in bags, you've also gone up and down the supply chain. How have you approached that in terms of what you think is, both good returns on capital and maybe good for the business in terms of giving it more optionality?
Yeah, absolutely. I think when I joined, we had to kind of decide where we wanted the growth to come from. Sucafina had been historically strong in Africa, had some assets in Vietnam, in Asia, and then had a very strong sales distribution network in Europe. And so when we sat down, the first thing we talked about was, well, where do we want to sit on the asset scale? Do we want to be asset light? Do we want to be asset heavy? Where do we want to play? And then on scales of vertical integration, how integrated do we want to be? And I think what we originally thought in 2015 when I joined versus where we are today has probably shifted a little bit. But one of the key focuses that's been consistent through those 10 years is the belief that the closer we can be to the farmer, the better off our business is going to be long term. And the reason for that is, 20 years ago, even 10 years ago, somebody sitting in Geneva, Switzerland with two phones, or, I guess nowadays with two chat rooms open, is able to buy and sell coffee. And that was good enough. But as we go through time, the demands that roasters have, because it's being driven by consumer demand and sometimes regulation for traceability, for ESG involvement, work at origin, the amount of things that we do today goes so beyond just buying and selling coffee. So if we had gone with the asset light strategy, we would have had a further reach to the farmers, and it really would have curtailed the amount of growth that we could have. So we've ultimately decided our goal is to have as much as possible fully traceable, transparent supply chains, and invest in the assets that we need to be as close to farmers and cooperatives as possible. So that means, in the terminology of coffee, owning a significant amount of wet mills. And here I maybe just should give a quick one over on how coffee flows. So it starts with the cherry. Coffee is one of the few fruits where we don't care about the fruit. We only care about the seed. The coffee bean actually is the seed of the cherry. So in the case of harvesting, when you pick the cherry, within 24 hours, you need to be taking this to a wet mill. That's where you depulp it. You take the seed, which is the coffee bean, out of the cherry. That has like a sticky, like honey surface around it that if you taste it right away, it's very sweet. But if it dries on the bean, it becomes very bitter and gives the coffee a bit of a lower quality profile. So there you have to wash it immediately. It sits in a fermentation tank. That can be 16 hours. It can be 2 days. It depends on the country. And from there, you have to dry it. So that's all the work that's happening really at the wet mill side of things. Once the beans are dry, they still have an outer layer of parchment on them. You send that to a dry mill. So terminology, wet mill versus dry mill. The dry mill is where you take all that coffee that's been dried, and it might have sticks and stones in it, so you have to clean it. You have different sizes, you have different density, different cup profiles. So that's where all that sorting happens. And you say, all right, well, I have to do this quality for Nestle. I have to do this quality for Starbucks. They have different amounts of defects, different sizes, different qualities, different cup profiles. So that's the work where you do all the segregation to ensure that you're doing the quality work for your customer, who's oftentimes the coffee roasters. So those kind of investments, I think that's where a lot of people, when they're a bit too maybe altruistic, are like, roasters should just buy direct from farmers and cut these evil middlemen out. And they don't realize the tens of millions of dollars that the middlemen are investing in these assets, which are actually what allow the raw product to get transformed into final product. So as we've been building out Sucafina, we go country by country and kind of say, what's the right asset base here? And occasionally we overshoot, we get a bit too asset heavy. We find out maybe we've put too many assets in a region that's starting to see production shrinking, maybe because of climate impacts or just the way coffee is being produced. Other places we've realized we didn't build asset bases quick enough. An interesting one is, a lot of people are now drinking cold coffee. So, when I started in coffee, my old boss just say, don't stress out. We're a morning beverage provider. Like we're not saving lives here. We're just a morning beverage provider. And that was his way of being like, just be cool. But what coffee has become is an all day drink, cold coffee has been a new phenomenon. And there's a lot of coffee roasters that sell more cold coffee now to consumers than hot coffee. And the interesting thing is when you want to have ice and put coffee in it, it can be dilutive. So a lot of times you need a coffee with heavier acid. So we were very strong in Africa, and surprise, surprise, the two places you have a lot of acidity are Colombia and East Africa. So suddenly we had clients saying, guys, we need more capacity. We need more washing. Anything you can produce, we need it, because that was being driven by the consumer taste profile, which was this huge shift from hot to cold coffees. As you go through the journey, you think of it as a commodity stable and it doesn't change and you can really plan. But even something like market dynamics and consumer taste profiles can completely change where we need the assets and what kind of supply chains we need. And rather than us just taking the Arabica coffee and doing it as a natural, we suddenly needed to be washing it. So we needed to build more washing stations. So those ebbs and flows, I think, are really important. And that's why being very close to not only your customer to understand what it is that they're wanting, but also understanding who is your customer's customer. In this case, the retailers, the ones who are selling to consumers, what are the new trends in consumer taste, we kind of have to have our antennas up understanding that market for the ramifications it's ultimately going to send back to us.
I've got two questions on the back of that, and one's for the benefit of the listeners. So the bulk of Brazilian Arabica coffee is naturals, and then traditionally most Arabica is washed Arabica. But what's the slight difference in the process there?
Yeah. So in the case of the natural Arabicas, you're actually able to just dry the cherry. So you're able to dry the cherry, and then later you're able to remove the coffee seed from it. So it's a cheaper methodology. Dominantly, this has been done in Brazil, and also in, let's say, a place like Uganda has a decent amount. Ethiopia has a decent amount of natural Arabicas. So those tend to be more known for their natural Arabicas. And it was always kind of disparaging. It's kind of like, okay, so you have Central America and Colombia, which have these beautiful washed coffees. And then you have these like really low quality natural Arabicas that are Brazil. And then you have the really nasty Robusta stuff at the bottom. And I think one of the cool things that's been the evolution over the last 10, 20 years has been how people have used innovative techniques to use a natural process, but ensure a much better quality natural coffee comes out. And today you can have beautiful natural coffees coming out of Brazil. So,
Yeah,
in
some of them are
simplistic
amazing.
terms, you'd still say the pyramid is washed Arabica, natural Arabica, Robusta. But I even know people doing specialty Robusta in Vietnam, and so
Yeah.
kind of it's turning the industry on its head and saying, well, it's not just the type of coffee anymore. It's actually what we call post-process or post-harvest processing. So once you pick the bean, it's what you do with the bean once it's picked that kind of can ultimately determine a certain flavor profile or quality.
Interesting. With all these assets, I think one challenge trading companies have is capital cycles, returns on capital, where they're getting their debt capital from.
Yeah.
Have you, like in terms of this like expansion into real assets, is that all self-funded? Do you have investment partners? Do you set them up separately? How does that, I mean, what you can disclose anyway in terms of, because a farm is a very different returning asset than a trading business, for example.
Yeah, absolutely. I think traditionally, again, going back to what people think of commodity traders versus the reality, margins within the agriculture world, as you well know, tend not to be as good as what people reading the Financial Times or the Wall Street Journal or everything else might think they are. There's
Yeah.
always a belief that we're making way more money than we are. Margins tend to be a bit compressed when you're in an agriculture product and you're running an asset base that has a high cost structure. So we have to be mindful in how we're setting these things up. And again, making sure that the amount of coffee that's going to go through the asset is enough to justify it. So the throughput, and that kind of builds a tension in trading sometimes because you might be saying, ooh, my buying and selling isn't great, but I need to do it because I need a certain amount of volume going through my asset to make my asset profitable and not be a drag. Or if I cherry pick and just pick the best sales prices, the best buy prices to make the biggest margin, then I'm losing money on my asset because I'm not putting enough volume through it. So there's always this tension in the business between those two things. In terms of financing in general, as Sucafina, we tend to finance things through banks. So we have a syndicate loan that does the majority of our, call it, financing base. We also have a few club deals that run in South America that do the majority of the financing. And that was traditionally how Sucafina had been run for a long period of time. Years ago, we did a private placement in the United States, and that was successful. And so we've done a couple more since then to just provide a bit of diversified funding. But it's something we have to ask ourselves. And, it's a wonderful thing to grow. It's very exciting to build a business. But the thing we found out in 2024 was if you grow really fast and then suddenly you have an explosive market, that big growth plus a very high price suddenly challenges your worldview very quickly.
Yeah.
So, the price volatility for those who aren't as familiar with coffee, we were at $1.50. By the end of 2024, we were at $3. So the price had more or less doubled. And then this year in 2025, just in January, it went from $3 to $4. And we've had this volatility where it's been $4, it's been $2.75, it's been back to $4. So massive amounts of volatility. And, we recognized during 2024, fortunately, what was doing the $1.50 to $3, we said we need to ensure that we have a certain amount of financial headroom, working capital. And it was really probably the first time in my life that cash conversion cycles and working capital became more important than what's the margin on the trade. In the
Yeah.
past, it's just like, oh, it's a good margin. I wouldn't ask if it was a 60-day, 90-day, 120-day cash conversion. It's like, we're like, oh, we're making 8 cents a pound, a phenomenal trade. Let's just book it. And suddenly we're like, all right, what is the transit time from point A to point B? How much credit does the client need? Is it 90 days, 60 days, 30 days? And it wasn't about the margin anymore. It was like, how quick from the time we buy it are we actually going to get the cash back? And we had to build better dashboards, better forecasting. And our treasury team, I have to say, was like world class. They were phenomenal. I mean, they accompanied us. We always ensured that we had extra headroom. And as a result of it, this year, our volumes will definitely shrink from where they were before, because we made the conscious choice already in 2024 as we were building the forward book. We just said, guys, we need to be careful, because what if coffee is going to $5? What if it's going to $6? In retrospect, you go, well, yeah, it was never going to probably go to $5 or $6. But had we had a frost that was more meaningful this winter time in Brazil, maybe it would have. So, we
Who
suddenly
knows,
realized,
right? Yeah.
okay, it's great to grow. It's great to have fast growth. Everybody loves it. But in times of high volatility, you really have to, as a manager, be able to pivot into that treasury cash management side of the business. And when spreads go, so the difference between one future month and another go from being in a nice, easy contango, which is easy to trade, to a big inversion, you need to be really careful on how much inventory you're carrying, because that becomes very costly as well. So it suddenly becomes a master class in managing price shock, volatility, inversion, high interest rates. Like, everything came all in one go. And it's been definitely a challenge, but it's also been a fascinating experience to learn how to operate in this environment.
Yeah, what's interesting, and I like just to double click on that a bit more in coffee as well, is that, you've also had overlaid that with tariffs, which is actually a common problem in other commodity markets. So
Yeah.
the whole cycle is very much shortened. And sort of, traditionally coffee would be very much a forward traded commodity. And now that sort of whole cycle is, trying to get, like, it's almost not possible to do it in 3 months, but people would like to
Yep.
do it in 3 months if they could, right?
Absolutely.
Um,
That whole compression of
how have the roasters have adapted to that, do you think?
Yeah, so it's an interesting one, because I think roasters on their side have the same cash pressures we do, right? When the price of coffee doubles, their cost of goods sold are also double, and they're working in a high interest rate environment. So I think the initial reaction to the roasters was, we're just going to reduce our pipeline. So when the price goes higher, that's easy enough for them to just reduce a pipeline, and the trade's going to keep bringing in the coffee. I think the thing that made this a little bit tougher was, as soon as the market inverted, it means that the nearby future month is worth more than the forward, right? So if you have inventory and you're sitting on it, it's worth more today than it's going to be worth tomorrow. So it's a depreciating asset. Suddenly the trade goes, well, I don't want to have inventory. And for the roaster, I think that was kind of like a watershed moment in 2024, where they're like, oh, wait a second. We can't necessarily depend on our suppliers, A, to make us a forward market as far as we'd want, and B, we're not able to count on them to carry the inventory that we need if we need as much spot inventory as before. So they don't really tell us what they're doing, right? They're always kind of like, it's a bit of Wizard of Oz, and they're behind a curtain, and we don't really know the magic of what's happening there. But my intuition is that some of them took it upon themselves to expand pipeline a bit more, to have a bit more working inventory. And I think when you throw in the ideas of regulation like EU deforestation, which had been delayed for a year, then it was back on this year, supposed to start in January. Now maybe on December 15th, they're going to delay it again. It seems like everybody's agreed to do it, but it's not finalized yet. And then you have the tariffs. One day we think that Mexico has a tariff. The next day we find out it doesn't have a tariff. The next day, everybody else has a tariff, and at different varying rates. Brazil has a 40 plus 10 tariff. Then we hear the tariffs canceled, but then we find out it's only the 10%, the 40 remains. Then 2 weeks later, no, the 40's gone as well. These are massive amounts of money that we're talking about. You're saying,
Yeah.
okay, the US consumes 25 million bags of coffee. So let's just say that that's, 3 billion pounds, and you have a tariff of $2 in Brazil, so you're just like, all right, it's a $6 billion tariff that's there, then it's not there, and it's moving. It's just, these are big numbers that are happening, and everybody's trying to optimize. Everybody's trying to save whatever they can. and you just get these distorted trade flows. And so I think it's not only about having a high market, it's not only about having an inverted market, it's not only about having high interest rates, but it's the regulatory and it's the tariff, the geopolitical that's there. And then suddenly you have roasters who are like, can you keep the coffee for me in Brazil for a few months? Or can you ship it to Canada? And then maybe later I can bring it in. Or if the EUDR goes forward, maybe I'm going to need to use a different type of coffee because maybe I won't be able to get enough coffee from, say, Ethiopia. So I need to buy more Brazil naturals and I need to buy less Ethiopia coffees. So it's always a jigsaw puzzle, which on one side, I'm not going to lie, it's super fatiguing because we've been like in firefighting mode for 18 months now. And it's like, you just
Yeah.
cancel vacations. You just say, I'm not going to take time off. And you're just like on and on. On the other hand, it's super intellectually stimulating and trying to figure out every day what that jigsaw piece of the puzzle, every day is a new puzzle and you have to put it together. And by the end of the day, it's expired and you have to start all over again. Just that intellectual stimulation of having to go through that and all the tricks that we've learned and the ways that we've had to adapt as a business. And I think we've seen, some businesses which have not done well during this period of time. And I'm not even talking about financial health, but their ability to maintain volume, to maintain service, to maintain quality. Some people have adapted better than others. I'm not going to try to tell you we've done the best. There's probably companies who adapted quicker than us and probably did a better job than us. But I think all of us have truly come away with this with a new respect for our industry. And I think the perimeters of risk that we understand, whether it be from a P&L perspective or from a cash treasury management perspective, I think we will operate as a more efficient industry having gone through this.
Yeah, I would agree. I think, the perpetual contango for 15 years sort of bred a lot of complacency. And there's some firms
Absolutely.
that we all know that aren't around any longer because of
Yeah.
it.
I look back now and I'm just like, it was so easy. I was like, what did I do during the 2000s? I just sat there like a fat cat. I had no clue. Like I was stressed out during that time. And I'm like, why was I stressed out? There was nothing going on. Yeah, maybe the market went up and down, but come on, it was so easy.
Yeah. Oh, no, it's crazy, isn't it? I guess to sort of move the conversation along a little bit in terms of like what I think what you just described is classic in my mind, classic commodity trading in a crisis. It's just not usually go for 18 months. In terms of you got a reasonably big global footprint now, the key there I think is communication, coordination, and then how you incentivize people. You kind of alluded to a bit before, right? When you've got assets and you've got throughput and you've got traders. In terms of, in today's world, there's so many ways to communicate. How do you, A, keep the communication going, but B, you can't be a large corporate and have meetings all day so people aren't actually doing any work because there's lots of decisions to be made every single day by lots of individuals. So how do you balance that in terms of communication?
Yeah, I mean, I think in general, my style of management, and I think the person that manages green coffee trading, his name's Jordan Hooper. So he's responsible for the day-to-day operations of the green coffee trading business. He and I would say are very consensus building leaders. So rather than telling teams you have to do this, it's more kind of saying, these are the reasons why we think doing this makes sense. And at the beginning of the crisis or the beginning of all this, we were under a consensus style management. And I would say trying to be decentralized decision making, because I've always believed you hire amazing people, you empower amazing people, and they do a great job. I've never been a belief that micromanagement is the way to go. However, during this crisis, one of the key takeaways that I had is there's a time where you just need to be a benevolent dictator. You
Yeah.
just come in and be like, you don't have a choice. You're liquidating that inventory. I don't care what it costs you. You're just selling it. You need to do this. You need to do this. And so I think our communication style probably shifted when we were more in crisis firefighting mode to where before it was kind of like, oh, I can just shoot an email. I can send a message on Teams. It was more, all right, we need to rally the troops. We need to get on a phone call. We need to discuss this as a team. And I'm still very much a believer that coffee, as well as probably all commodity trading, is people driven. Despite all the advances in technology, it's still people, it's still communication. And you have to find that cadence. We started having more and more meetings. We noticed that our schedules were getting fuller, but we didn't always feel like we were accomplishing as much as what the meeting time increase had allocated. So we've had meetings that have become daily meetings. then they become monthly meetings, then they become weekly meetings, bi-weekly meetings. So I guess what I would say is that my understanding in terms of how you communicate most effectively is not to stick to one formula. One formula doesn't fit all. When you are going through a treasury crisis, you have immediate treasury meetings. When you're going through a supplier default risk style, you have immediate meetings. When you're going through questions around assets and capex and what you should do in the middle of this, you have immediate meetings, but you don't keep those exponentially running. Like you don't keep those recurrent. So,
Yeah.
I always have an expiration date on my recurrent meetings. So let's say I set up, a unique once a week meeting but instead of keeping it recurrent forever, I'll specifically put it for 8 weeks. And then the eighth week, it burns off. And if I don't notice that it's gone, it's probably because I don't need it anymore. And I think one of the sins
Yeah.
we make is we tend to commit to those recurrent meetings and just keeping them going. The second thing I did is I'd take what most people would say was an hour meeting, and I'd make it 40 minutes, not 30, not 45. I'd make it 40 minutes for a reason, because that usually meant nobody was scheduling something for the 20 minutes between. And that gave people a chance
Yeah.
to breathe before the next meeting. Because the other thing that happens that I find very fatiguing is when you hop from meeting to meeting to meeting to meeting the whole day long, and you just don't get those breaks in between. So I think those are a few things we've tried to do to help the staff, be able to cope and manage things. And now, as we've gone through what I believe most of the crisis is behind us, we've really started to scale back those meetings and looked at our calendar. And, we've even said that for 2026, we're going to try to not have any internal meetings on the day of Wednesday. Like we're going to have one day a week where it's an open calendar. It doesn't mean you can't call somebody and talk to them, but recurrent meetings, structured meetings, we're going to try one day a week not to have any of them, just to have employees be productive on focusing on other things that they need to do. But death by too many meetings is very tempting to do.
Oh yeah, it's very exactly. And I think, I mean, do you take advantage of, using, I wouldn't say like traditional IM, but, like a Slack or Teams in terms of channels and stuff like that, in terms of keeping
Yeah.
people up to date, but not necessarily having to send an email or have a call.
My least favorite thing is when I'm on CC of an email. I hate being on CC because now I'm
Yeah.
accountable. I have knowledge of what you're telling me, but it's not sent to me and I'm not really supposed to be reacting to it. Like that's my least
Yeah.
favorite thing, but it is a reality. And I think what's happened is a lot of those style emails have moved over. We use Microsoft Teams. Sorry for the Teams lingo, but we use a
Mm.
team channel. But what we found is now I have 250 channels.
Mm.
So, we sat with the team and we just said, all right, now at the end of 2025, like spring cleaning, we need to go through and start deleting channels and try to reduce that. So we start 2026 only with the channels that are needed.
Yeah.
Because when you get too many channels, then people start posting the same information in multiple channels. They're like,
Yeah,
oh,
which
well,
is
I need to
pointless.
post it in the Vietnam channel because it's relevant to Vietnam. I need to post it in the Robusta channel because everybody in the world needs to understand in Robusta. And for our sales teams, they need to understand. So I need to post it in the sales channel. So like I'm seeing the same thing in 3 channels.
Yeah.
So it's also like, how do you build that architecture? Again, I don't claim that we've got the secret sauce. We're still learning, and I'm always comparing with peers when I meet with them. I'm like, how do you handle your channels and your teams and your communication? Because I do think
Yeah.
that that's still somewhat of an Achilles heel for our industry.
Yeah, I agree, right? I guess further to that, the teams, like in terms of coordination and, again, the perception, but also like a pure trading company, incentives are pretty clear, right? Make money, you'll get paid.
Yeah.
And I guess just for some context here, for people who aren't familiar with, say, physical trading as much as, say, pure prop trading, is a physical business is slightly different because it is actually a business with
Yeah.
customers that you have to care about and people in different locations, and not everyone can make money every year, even if the business makes money every year. And, you've all got to, there's different ways of doing it. You have some physical trading companies where different offices can compete with each other. There's other ones where there's, one person runs the whole thing and there's one P&L and there's, incentives are distributed according to some, the benevolent dictator or some formula. But in terms of, like, without going into too much detail, but in terms of, because I
Sure.
think it's important for people to understand what are the different approaches. And there's just, in my mind, I don't think there's a perfect incentive structure. It's just what you're prepared to trade off and what suits the business and what suits the personalities. But,
Absolutely.
if you could elaborate on, how you've, because you've worked at sort of 3 quite different businesses.
Yeah.
Uh,
Yeah. I agree. And I think you laid the ground perfectly and already kind of explaining some of the different options that you have. I think when you speak to people, ultimately, they more times than not say, I want to be compensated for what I deliver. So I think you need to have some sense of accountability and some sense of compensation that is tied to performance. Different where people vary is that some people would say it really depends on the individual. Some people will say it depends on the group. Some people say it depends on the country. Some people say it depends on, are you an Arabica or Robusta? So let's say from a quality perspective. Some people say it depends on your geography, Africa versus Asia Pacific versus North America. And some people say, let's just do it all up at the top in one P&L system. And I think that the ideal system is not, it's like the communication. It's not set and forget it. It depends on what stage of maturity your company is, where you are in your growth cycle, where you are in integration, where you are on teamworks. A team that's worked together for 20 years is very different from a team that's like 1-2 years together and growing. So your incentive structures need to change. So I'm not a proponent of saying this is the magic formula that fits for all companies. I don't know why people aren't doing it. We at Sucafina have gone through multiple iterations of ideas. The main one that we had while we were growing was that we needed to be more one P&L system. So we had different profit centers. So we could see the profit of all the centers, but I didn't have one team in origin fighting with one team in destination for a couple cents a pound and then saying, well, screw you. I'm just going to sell it to your competitor because they'll pay me a 1 cent a pound premium over what you're doing. It was more, guys, we want to maximize the P&L between both of you. At the end of the day, we're going to split the cake and both of you are going to get a piece of the cake. And if we recognize that you're needing to give more margin to this person, we're going to try to, within the management books, so not the accounting books, but the management books, we're going to try to make those adjustments and we're going to try to be as fair as we can. But let's say that you've made money for 4 years in a row and then the 5th year you lose money. Under our model, as long as we made money as a group, you still had some compensation coming even in the year that you lost money. Maybe it was smaller. The one who was the rainmaker of the year got the bigger compensation, but there was something in it for you. And then in the years where you were the rainmaker making the biggest amount of compensation, maybe you weren't getting 100% of what you deserved in the rainmaker year. There was something being taken out and giving to the person who had made money last year but was losing this year. So a bit of a balancing system and that was there. The issue that you have is as you start to get into, let's say, a more mature company is the people who are consistently making money don't want to be subsidizing those that aren't, and I know the feeling because I remember days when we were in Noble where, we would have a good year as the coffee group and they'd be like, oh, but the bonus pool, we need to take a bit out because we're launching this new energy trading group. We hired all these people from Goldman. And once they make billions of dollars, you guys are going to get part of their bonus pool. So you're going to get way more than what the coffee group should ever get. I never saw a penny. And that's not to scam my ex-colleagues who came from Goldman to Noble and build amazing natural gas electricity platforms, everything else, I mean, lots of love, no hate. But I never saw a dime from anything they made into my bonus pool. Like nobody ever said, oh, your bonus pool surprise. It's better than what coffee did because your peers are contributing. So I understand that sense of if you're consistently performing at a high level and profitable, you don't really want somebody coming into your pocket and taking out every year. So I think as you get more mature businesses, each one can stand on their own. But when you're truly in that growth phase that we went through, we knew when you set up a new business, they're not going to make money year one. That setup cost is just too high and the volume that you're able to trade isn't big enough. So we knew that we still, in order to promote that growth, we had to have a one P&L where we could be taking and investing. But as those businesses grew, everybody was happy to have that extra money that was coming into the bonus pool. So it's fine. But once you start hitting more of a cruising altitude, as the business stabilizes, I think that's when you need to more try to directly tie comp to that individual business's performance. Having said that, the tricky thing when you're running and managing a trading company is you have this guy who made, say, $1 million in this country, and you have somebody who lost $1 million in this country. So you as the manager of the business, you as the owner of the business, you've made $0. But the one who made $1 million is like, I'm a rock star. I should get a huge bonus this year. Very next year, the one that lost the $1 million makes $1 million. The one who had made $1 million lost $1 million. And the one that made $1 million goes, oh, I was a hero this year. I should get a big bonus. Now for 2 years, you've paid both guys bonuses, but you've actually lost money because the money you're paying the bonuses is out of your pocket. You haven't made a dime. So, there are groups that say, listen, in order to pay bonuses to the rock stars, we have to hit at least a certain level of profitability. And then a bonus pool starts to get created. And out of that bonus pool creation, first, we're going to compensate the rock star, the one who made the most money. And then we'll compensate the other people as we go down the chains. But there's no secret sauce that I've seen that works perfectly. I know from when I was a younger trader, I'm like, I just want a fixed percent. Just tell me what percent of what I make I'm going to get. And now that I manage a group and I see those complexities of the offsets and everything else, I'm like, now I understand why nobody wanted to give me a fixed percent, why it is so tough to get through. So I think as you have different roles, you have a different perspective that you can bring to it. But I'm empathetic to the younger trader who's ambitious and feels they should have more clarity, because I was that person. So I get that perspective as well.
It's always frustrating. In terms of trading, Sucafina is diversified into still within coffee, but other businesses. I guess what skills do you think either yourself as a trader or that you see in good traders in general that are applicable in other parts of either your business or in other pursuits, whether they're investing or other things,
Yeah,
other parts of life? I guess um, trading is very stressful and often people think it's one dimensional, but it's not.
yeah.
How have you found that in terms of applying those skills in other parts of the business?
Yeah, for sure. I think that, when you think about what makes a great trader, there's obviously multiple skills that come into mind. I think the first one is obviously a certain level of IQ and curiosity. So you have to be interested in the world around you, understand why it works, how it works, where it's going to shift and pivot to then be able to anticipate your trading decisions that you need to make. Second, I think it is a people person business. So I think the ability to relate to people matters greatly. In the case of coffee, I think the range is maybe a bit larger, or agriculture in general. I need to be able to go to a farm in Brazil and sit down and have dinner with the farmer. And then a week later, I need to be at the conference and be able to have a conversation with the CEO of Nestle, and then I need to be speaking to a regulator in Brussels the following week about things. So, you have to have that ability to really interact at different levels with people. And then I think that the other skill set that is oftentimes very common is really quantitative focus on details. So I've met lots of really nice people who've not been able to be successful in coffee trading because they didn't have the organization and attention to details. So they could buy and sell a product, but then they wouldn't actually follow the quality. They wouldn't follow the shipments. They wouldn't follow the cash usage. They wouldn't follow the mark to market. They wouldn't follow the risk, and those are all things that would blow somebody up. Or when you're talking about an asset structure, somebody who operates a dry mill, you need to understand what we call yields. When you have a batch of 100 beans coming into your factory, you need to understand how many of those are going to be high quality, how many are going to be low quality, what the weight is going to be afterwards. Are they smaller, bigger, dense, and so what you put in as it gets processed is not always what comes out. And if you expected 80% high quality and 20% low quality, I'm just going to simplify it. We have maybe 20
Mm,
quality in that mix, but let's say 80-20, and you ended up getting 70-30, like you just lost a ton of money.
mm,
So the understanding of how does a mill work? How does the processing actually work? How does that have an impact on my yields? And I think that's directly transferable probably to a coffee roasting factory. So we have a private label coffee roaster, Behrends in Belgium. And the person that runs that, actually the CEO, came from green coffee trading, but he had to have
mm,
that exact same curiosity. It wasn't a dry mill, but it was a roasting factory. So how do we take that green product, and whether it's a capsule or a pack or a pad or whatever they're processing, how does that whole conversion process go through? What are the parts that are beneficial, not beneficial? So to a point, you almost kind of need somebody who has an engineering either background or a skill set like an engineer that can really take those pieces apart and put them back together. So if you think about intellectual curiosity, desire to constantly be learning and evolving, strong people skills, quantitative ability to look at lots of data and simplify it to get key insights. And then that attention to detail, that's, microscopic, really understanding the business. Those are skills that I think apply outside of coffee trading and a whole large realm of other businesses. And I know for myself, I know my weaknesses within those skill sets where I lie. I'm not great at engineering. I'm not great at understanding the machinery. That's not my skill set. So I've always surrounded myself with people who do have that skill set. I think I'm okay quantitatively, but I'm not like masterclass quantitative. So I brought in strong quantitative people to surround myself with. So I think understanding what the skill sets of success are, but then also understanding very honestly when you look in the mirror what your limitations are, and then ensuring that you're bringing in people who are better than you at some of those specific things that maybe you're weak. I think that's the basis formation of building a successful team and being able to do it. So sorry, I deviated a little bit away from your question there.
No, that's good. What about decision making in terms of, especially like the last 18 months is like hyper, lots of decisions with very imperfect information.
Yeah.
How do you think that skill set, is useful in other bits of information, whether you're making acquisitions or choosing to invest money in a new asset or selling an asset or,
Yeah.
other business decisions?
Yeah. There's a real debate there. There's some commodity traders who feel like their gut is God. And, it's like, I can make any decision on the spot. You just tell me what decision you need me to make and I'll make it. And you have other traders who are like PhD academic professors who want to go away for 6 months and study like every nuance of that decision to be able to get there. And I use those two extremes because everybody knows where I'm going, right? The happy place is in the middle. And whether you're at the 3-second decision or the 6-month feasibility study before you make the decision, obviously depends on the crisis you're facing, the time, the reaction speed that you need. But I think for me, the way that we've learned in this crisis is, again, it's not me, Dave, making the decision. Even if it's a trading decision, it's been me, Dave, working with my peer in finance, working with my peer in risk, working with my peer in logistics operations, sometimes working with my peer from, let's say, the CEO himself coming into the conversation and me bringing them in and being able to very clearly articulate, this is the decision we need to make. These are the different options. There's no option where we don't have risk. There's no option where this thing can't turn upside down. These are the risks and reward. I call them the poisons. This is the positive. This is the poison of this idea. This is the poison of this idea. We need to pick one of them and we need to go in eyes wide open. So I think, for me, it's about how do you frame things? And I make imperfect decisions every single day. As you said, we don't have perfect information, but the speed of making decision needs to be fast enough that it can keep up with the business. So for me, I try to just say, let's, if 80% of the knowledge we need can be found instantaneously, and the next 20% takes a day or takes a week and we don't have that, we're making the decision on 80%. But let's understand we only know 80%. If it's a flip of a coin, let's at least voice that in the room and say, listen, this is a decision we need to make, but it's a flip of a coin. We're blind here. So I always try to frame it in those, probability. The CEO always likes to be like, all right, Dave, from 0 to 10, where's your conviction on this idea? He likes the 0 to 10 scale, and I tell him this is a 4, this is an 8, this is, and so you learn with the people that you're working with as well, what jargon or what scale or what amount you need. But I think that you have to be able to be fairly quick in decision making in commodity trading rather than slow. And you have to be very comfortable with incomplete information. And when you get it wrong, you also have to forgive yourself. Like if you just beat yourself over every bad choice you make, like you're going away. And, I know it's been widely shared on social media, but I loved it. Roger Federer giving, the graduation speech. And he's like, I only won 55% of all the points I ever played in my career. I lost 45% of the points I played. I think commodity trading, for me, that resonated.
Similar odds, right? Yeah.
Where I'm just like, maybe my ratio is a bit higher than that, but maybe not by much, so you do have to understand that you will make those mistakes and you live with them and move on. And every day you try to just make the highest quality decision you can. And I tell my team sometimes, even if the result is bad, as long as the quality of the decision we made was high, I'm at peace with it.
Yeah. Because you're going to have to make another decision probably in the next 24 hours, right? You can't dwell
Making
on it.
high
Yeah.
quality, if you're consistently making high quality decisions, like your process to get
Yeah.
to the decision making was sound, and with the
Yeah.
information you had, you made the best quality decision you could. Then if the outcome's negative, you can live with it because you truly left it all on the field. You did the best you could. If you're just shooting from the hip and just making decisions without really taking the time to analyze the data that is available to you, then when you lose, you feel bad. Then it's like, oh,
Yeah.
that I was distracted. I had to do this for my kid. I was feeling sick. I just made a crappy decision that I should not have made. Those are the ones that stay with you longer.
Yeah. I'd agree. I guess just before I wrap up, one thing on the industry, I'd say the coffee industry isn't that vertically integrated versus some other commodity industries.
Yeah.
Do you think that might change after this sort of challenging period where people want to become more integrated? Either the roasters want to get closer to the source of the coffee, or the traders feel like they need to have better integration, or, more of a fee for service
Yeah.
revenue stream in their business?
It does feel like that is slowly happening. I thought it would happen faster than it has. Like, I really thought that traders would become more vertically integrated. I think where traders have kind of moved is into owning soluble factories. So instant coffee, they can produce instant coffee in factories. The trade has been very quick to move into that side of the business. But on the industrial kind of like we roast, we pack, those kind of things, there's been somewhat of a taboo maybe where roasters have been like, oh, then you're competing with me. You're not a supplier. So I think there had been historically that mindset. But I think as we've gone through this current crisis and then suddenly tariffs, for example, or EUDR regulation, some of the roasters are like, actually, it's great if I have a few suppliers who have the capacity to offer me green coffee FOB, green coffee delivered, or coffee roasted, packed, and done. It's just one more service. All right, it's not actually them competing with me if they don't own a brand or anything else. So I
Yeah.
do think that there's scope for the trade to become more integrated, but we can't forget that there's market consolidation happening at the same time. So the size of the industry, there's fewer players, but the players are much larger, and the amount of working capital and cash that you need to own a larger roasting facility is so great, and trading companies tend to be a bit leaner on cash structures, that maybe that's a bit prohibitive. But I would continue to expect that the industry becomes a bit more vertically integrated. We don't see roasters really moving towards like, let me go acquire a trade house so that I have a dedicated traceable supply chain, even though maybe it would make sense to do that or could make sense to do that. But what we do see is sometimes them opening up an office in a country and trying to buy directly from the local people. And usually what tends to happen when they bypass this is that it works for 2, 3, 4 years. Then you get a big market rally. They get a large default, just like the defaults we get, but they actually get the
Yeah.
taste of what a default is. And they go,
Yeah.
why are we getting these huge defaults and taking on all this risk to try to cut the trade out of a couple cents a pound? Just pay the
Yeah.
trade, let them take the defaults. Let's de-risk our business, and let's focus on our business, which is selling coffee to consumers and not trying to cherry pick a few cents a pound. So I think there's a bit of ebb and flow, but the answer to your question is I do expect more vertical integration to come. I had expected it if you had told me 10 years ago. Do you expect it? What do you expect for 2025? I would have told you we'd have more than what we have today. So it is also fairly slow moving.
Yeah. Interesting. One last question, which is sort of industry as well. So earlier in the year, I was doing some research, and I don't think it's actually changed that much. Both the coffee market and the cocoa market, which have had huge, multiples of, the original price underlying, record highs. But interestingly, the open interest in the futures markets are deteriorating, and in cocoa, it's gone back to sort of lows not seen for a long time in open interest terms.
Yeah.
Do you think, the, coincidentally, it's the same exchange across all the different markets. But in terms of, do you think that's a function of a change in, a little bit what we talked about at the beginning of the conversation, where there's just less long-term hedging going on, so there's less natural buyers and sellers participating in the forward market, and they're sort of more focused in the spot market? Is it to do with speculation? Is it to do with regulation? I mean, do you have any? Because you would think,
Yeah.
often markets, when they post new highs, they're record OI, record volumes, etc.
Yeah. I think in a normal, healthy market that has a big rally, we see record OIs. And we've seen that in the past, where markets have been at high prices. And we've seen, that's a point where farmers are like, okay, I'm happy. I want to sell. I want to sell this crop. I want to sell the next crop. I want to sell the one after. I think what's happened in these markets is that, first of all, because of the surge of the price, we had a large wave of delays, if we can put it that way. That's the diplomatic trader code for defaults that happened in 2024. And so suddenly Brazilians weren't delivering, Colombians weren't delivering, Mexicans weren't across the board. Vietnam, it happened at the end of 2023. So, there were periods of times where I think the trade just said, okay, I'm not going to let people hedge as far forward. So because we're not allowing that forward hedging, and we're not buying coffee as forward, that does reduce the OI. The second thing is that small markets can be pushed around quite easily. And I am not a cocoa trader, so I'm not going to tell you this is the case in cocoa, but I would guess people don't always feel that the market price or the price of the spreads reflect the fundamentals as much as they do as somebody who's bullying a position around. And I don't think that the exchange has been very proactive on how they've managed orderly markets. I think they've been a little bit more hands-off. And maybe that's allowed the cocoa and coffee markets to go a bit more wild than they probably should have, according to the fundamentals. Again, I don't know the cocoa story as well, but in coffee, I feel like we've exacerbated the situation. You can buy coffee today in origin, ship it to the exchange, deliver it, and make money. Yet you have a spread that's at the front spread at a 30-cent premium. There's such a disconnect in the physical versus the futures market that I think there's a lot of players who are just saying, let me not play here. And then when there's low liquidity, low liquidity causes even lower liquidity. So I do know that there have been some roasters who have just said, listen, I'm going to bypass hedging altogether, and I'm just going to buy direct from suppliers at a flat price level. So at certain points in time, and then there's no hedging that even comes into the exchange as a result of that. So I think confidence in the exchange is, at least for the coffee side, or probably confidence in the fairness of how they're functioning is probably on the lower end of the spectrum right now, to keep things diplomatic.
Yeah, that's a good point to finish on. But I would agree. It's an interesting dynamic. Typically very high prices see very high liquidity, and you're not seeing that. But look, Dave, I know you're busy. We'll wrap up there. I really appreciate you making the time, and that was a thoroughly enjoyable conversation. Your knowledge of the coffee market is fantastic, and I hope people who either like coffee or know coffee or have no background in coffee found it as interesting as I did. So thank you very much.
Thanks for having me. This was a lot of fun. Good to see you again.
Awesome. Thanks, Dave.
All right. Cheers.
Cheers.
I hope you enjoyed this episode of the GSX podcast. You can find out more about GSX at greatsouthernx.com and follow us on X at GSX Commodities. You can also follow me, Henry Walsh, at H2Walsh. Until next time.